So you know how life is super busy and there's so many financial products and there's so many financial people, it's hard to make financial decisions? I'm Adam Gain, owner and financial coach of Gain Financial. We help families with businesses as a one point of contact to integrate, coordinate, and organize your whole financial economy so you can save time and energy and live the life you want to live.
Okay, so we've now talked about Rule 2 and savings and Rule 3 and liquidity. Let's go back to Rule number 1, maximum protection at minimum cost, and start going into the protection component. Now, as you know, P1 to P9, as you go from P1 to P9, your decisions get more and more important. So if it's okay with you, I'd like to start with P9, go into life insurance, understand what options you have, kind of like a life insurance 101, and then we can talk to see what's appropriate. Okay. So there's two main types of life insurance. There's term and there's permanent. So term is like renting the house, or renting a house. You know, typically you get into term because the premium is lower. Doesn't mean the cost is less. We'll talk about that. But the premium is lower. It's same kind of like renting versus buying. And the goal would be to get into the permanent. So if we're talking about term insurance, you know, when we think about life insurance, we think about what? Death benefit, right? You know, but I do like to say it's called life insurance, not death insurance, because there is some living benefits when you get to the permanent side. So with term insurance, you have a death benefit, and of course you have a premium. I think most people understand there's those two things. Now with term insurance, it has a few different flavors. You can get a term 2 or a term 10, a term 20. You can probably get term 30 with some companies or term to 65. So there's a few different ways of setting it up. And of course, the longer the term, the higher the premium. If you get a shorter term, then it's a lower premium. Now, usually the policies, you have to be careful. So I'm just gonna mention, there is mortgage insurance, which is different than what I would sell with like individual insurance. So you do have to be careful. Typical mortgage insurance is just through the bank with your mortgage, and it's gonna you won't even see it. It's gonna come out automatically. The coverage is going to go down over time. Now, it's not gonna be level, it's gonna go down with your mortgage. Your payments will stay the same, and typically your payments are the same. They don't go down as well. The other thing that I don't love about mortgage insurance is the money goes directly to the bank from a death benefit. Individual insurance, it's level, your premium is gonna be the same for your term, and it's gonna go to your beneficiaries and they can choose to pay off the mortgage, right? Now death benefit, life insurance isn't just there to cover your mortgage. I know a lot of us think about, well, I have a mortgage, I have to get life insurance. There's so much more to it, and we will talk about it in the future. But let's go back to the premium. So if we're doing any term, no matter what, over time, the term cost is gonna go up with the term you get. Let's say if you got a term 10. In 10 years, the cost is gonna go up. Now, one thing to note as well, a lot of people don't know, most of the individual policies we sell, they're called guaranteed renewable. Meaning after the term 10, they will renew it automatically with no underwriting, no medical underwriting. But your premium is probably going to quadruple. And what the insurance company is assuming is that you are uninsurable. So they're gonna quadruple your payment. But if we go and reapply for a new policy, then we can get a much better premium. So it's always worth watching if your premium is coming due, then, or your term is coming due, we wanna reapply if you're healthy. If you're not healthy, well then we might be forced to do that. Either way, the cost is gonna go up over time. Now, typically, around 65, everyone cancels their term. It gets so expensive at around 65 that it just doesn't make sense. And that is the biggest day in your life that you disinherit your family.
Oh no.
Right?
That doesn't sound positive.
No, because you just have all this death benefit you've had for forever, and they were going to get it, and now it's gone.
Yeah.
And if that happens, then your term insurance becomes a pure cost to you, because you just paid all of these premiums throughout your whole life, and you lost all of that money. Now, you didn't just lose what you paid for the premium, but you lost what it could have grown to, and now it's just a pure cost. Now, I'm not saying we shouldn't do term insurance. I still sell a lot of term insurance because it's just like rent. A lot of times we have to rent before we buy. It's just not very efficient. Mm-hmm. And I don't like setting up products where if what you hope to happen happens, and you live a long life, then you lose, right? It's also good to note that less than 1% of all term insurance gets paid out.
Really?
Yeah.
That makes sense because the term ends before you die.
Exactly. So you typically, like our chance, that just tells us, like if you're at standard risk, meaning that you don't have other health affecting that they wouldn't rate you, you have a less than 1% chance of dying before 65, which is pretty consistent in our metrics. So last thing I wanted to mention on term insurance is, who do you guys think sets the premium for a certain amount of death benefit? It's not a trick question.
The bank, I would assume.
Not the bank, but who issues the policies? Not banks, insurance, yeah.
Oh, okay.
So the nice thing in Canada, we have a capitalistic market. There's a lot of different insurance companies. They're all competing for your premium dollars, and it keeps the cost low. And as we are developing more and more technologies for living a longer and healthier life, these premiums have been going down. So pretty cost effective from a premium standpoint, but could be a pure cost if what we hope to happens. Mm-hmm. Okay, so let's get into the permanent coverage. Now there's two main types of permanent. There's whole life and universal life. We're gonna go into whole life first, and then we're gonna start talking about universal. So again, permanent is like buying the house. With permanent insurance, or with whole life, we have the death benefit, so we have a level death benefit. And now it is guaranteed because they know that you're gonna die, right? That's one thing we know. That's one thing I like to talk about with life insurance is, like, if we look at all of these elements in the protection component, life insurance is the only one of these boxes that it's a when. It's not a what if. You know, what if you get disabled or get a critical illness or you get in an accident? This is a when. We know that that's going to happen. So we have a guaranteed death benefit now. And of course we have a premium. Now these premiums with whole life insurance, they are guaranteed level. So that the earlier we can get into a policy, the better premium it's going to be. Obviously you're younger. And these come in different flavors as well. So we can get a pay for 10 years and you're done. We can get a 20 pay, or we can get a life pay. And there's different advantages and disadvantages to each of these things. And that's kind of what we help walk you through, and we kind of give you a recommendation based on what you're looking for. So this is what I would say is where most people, their education is done in whole life. They know a premium and a death benefit, right? But there is a third big piece, like equity in the house, and that's your cash value of your policy. The full name is the cash surrender value. So if you surrender the policy, just like if you sell a house, you're going to get your equity back. Now, there's a few guarantees in this policy. So number one is that the cash surrender value will equal the death benefit by age 100. So that tells us that the cash value will go up every single year, no matter what. Like in every policy I've ever sold, the cash value is going up today, and it's going to go up tomorrow, and it's going to go up a week from now. So that's one thing we never have to worry about. That's in the contract. And this is where I would say the next portion of people understand about whole life. But let's go even deeper. We're using a special type of whole life, and think of it as like an investment grade whole life insurance policy. And this is called participating whole life, or PAR for short. And with a participating whole life policy, you get to participate in the profits of the company. And what the companies have, they have these PAR accounts, and these have billions of dollars in these accounts. And this is where all of your premiums go. This is where death benefits are paid from. They also are going to have some admin costs. And of course, this money isn't just sitting there, it's invested all over the world. But they're guarantee you that cash value to increase. So they're taking all the risk. This is also where you can get loans from. So you can use your cash surrender value as collateral. Your money stays in the policy, and they can loan you money out of the PAR account. And of course, they're going to charge you a rate that whatever you pay them back is going to go into the account that you will get to participate in. Right? So when you pay back a loan in an insurance policy, you're participating in your own profits, or you're paying back some of your own money.
It's very different from the other kind, where
Yes.
you just put the money in and it's gone.
Yeah, the term, yeah. So what the company is going to do is they're going to look at, what do we think we're going to bring in premiums? What do we think we'll have to pay out in death benefits? What are our admin costs? And what do we think we'll make on our investments and our loans at the beginning of the year? And they're going to set a bottom line. The crazy thing is, for more than 100 years straight, they have produced profits above their expectations because they're very conservative on what they do. And so there's always safety factors involved. And when they do have a loss, let's say in like 2022, when the market went down a lot, first off, they've got a lot of other safety nets going on. So this is very invested very diversely. So their losses probably look very minimal if they even did have some. And if they do have a loss in a year, they can spread that loss over 30 years. And so what they're going to do is, whatever the difference between what they expected and what they actually did is split up and paid to the policy owners as a tax-free dividend. So as long as we keep this within the policy, it's all tax-free. This is the third vehicle we can store money and grow tax-free. Now we have different options with this dividend. We can take this dividend, and what we usually set our policies up, and we keep it within the policy, and we go buy more insurance. This is called paid up additions. It's buying you 1 year permanent coverage. It's paid up. And what that does, if we do this every year, it's increasing your death benefit over time. Now, of course, if we increase your death benefit, we also increase your cash value because of the guarantees. Mm-hmm. So that's a great use of money, and we can keep up with inflation with the death benefit and have more and more over time. And we can really increase our cash value over time that we can utilize in a lot of different ways. Now there's other options. You can put this dividend in a side account. I don't really know who does that. It makes like 1% or something. It's like a very minimal, it's like a high interest savings account. Or you can take this money as cash if you wanted. What's the problem there? It's coming out of the policy. So there's probably at some point, there's tax consequences. There is ways to get money out of the policy tax-free under certain circumstances and depending on a lot of different things. Typically, if you just keep refunneling it back in, you're going to have the largest growth possible. And the last thing we can do with this dividend is we can take it and we can go and pay the premium. So if we get, let's say, like a life pay policy, but you're like, Adam, I don't want to pay for my whole life. I want to pay until maybe I retire or at some point, and I want to eventually stop paying this premium. Well, if your dividend is large enough, we can go over here and we can use it to pay the premium. The one thing to note about the dividend, it is not guaranteed. So it is based on the profits of the company, and they set the dividend scale, and they can change it. Typically over time, I haven't seen a change over 0.25%. They're not changing it huge amounts. There's a very low deviation in their rates. So the projections we show are can be based on current dividend scale, even like -1 or -2. We can show those different projections and make sure we have some safety factors in. If you do this with the dividend, this is called offset. It's also good to note that the more insurance you have and the more premium you've put in, the bigger dividend you get. So it's like, think of it like they're splitting up what they make, their profits, to all of these different policy holders. So someone with more and more coverage and has put more money in is going to get a bigger portion of that. So that's why we really love using this paid up additions. All right, so that's the part of the PAR account, how that works. And now I'm going to go back to kind of what I asked in the term policy. Who do you guys think sets the amount of premium for a certain amount of coverage? And it's not the insurance company.
So in this case, are you talking like it's us because we're determining how much we want to put in?
That's what I'm thinking.
It's not you either. You can you can add more or less premium, but it's going to change how much death benefit you have. So I can't say you can't put in like 100,000 and we get like a $200,000 death benefit. We can't decide that.
Oh, sorry. Like the actuarials, people who base the risk on your life.
It's not the insurance company either. So it's actually
It's you.
I wish.
Okay.
It's the government.
Oh,
Okay.
So the government came in here in 1982 and they said, wait a second, you're putting money in here, it's growing tax-free, and it goes to your beneficiaries tax-free.
Tax-free.
When do we get our money? So they set up this line called the MTAR line, and it limits how much you can put in how quick.
Okay.
And this is why it takes, if you give me a lump sum of money, I can't just put it all into life insurance immediately and it's paid up for life. Mm-hmm. Now there's ways and there's really cool things we can do to get in money quicker. And one of the things that have been coming out more recently within the last 5 years is there's the flexibility of adding deposit option. Now, deposit option with a certain company, it's different for every company, and in the past, it was much less flexible. And now, with some of the newer products that are coming out, it's 100% flexible. So we can set up a deposit option, and what a deposit option is doing is it's literally maxing out to that line, that MTAR line. So you're getting as close as you can to it. And if 1 year you want to put in an extra 5,000, you can. And or maybe it's 1,000. You can kind of change and decide, and depends on how the design of the policy. So there's a lot of ins and outs that we help navigate.
Would that help if you didn't start the whole life policy at a young age? Like that helps you kind of catch up?
It does, yeah. Well, it's really, and it's especially if you really want cash value and you want to be able to utilize that, because the deposit option is doing the exact same as the dividend. It's gonna buy more insurance right off the bat, paid up insurance, and that's going to increase your death benefit even more, and of course, going to increase your cash value even quicker. So it turbocharges the policy. But a lot of times we'll add deposit option on because maybe you can't afford the bigger premium, or it's not appropriate yet, but you still want to get the house. And then later you have more money, then you can add more. So there's a lot of different ways we can utilize that. All right, I know this looks complicated now, but does this make sense?
It does, actually, yeah.
Real quick, I'm just going to get into the benefits. When I talk about whole life insurance and permanent insurance, like Universal has a lot of these benefits too, but we'll talk about that in a second. So we've got the cash surrender value. It's our money. It's growing tax-free forever. So there's the tax advantages. We've got the dividend. So the dividend's not guaranteed, but the companies that we're using have been doing this for so long and they're so good at it that, those dividends look really good. We've got the death benefit, and we can make sure our family's safe. We've got a whole bunch of estate benefits, so there's literally no way to pass on money in a more efficient way. You're using pennies to buy dollars, and you're giving those dollars tax-free to next generation. So you're setting up your family and the next generation after that. Right? You're setting up all the generations. We've got, depending on the type of policy, there is some critical illness, disability, and long-term care options. If you get sicker in some policies, you can get cash value tax-free. There's creditor protection. So if anyone sues you, they'll never be able to access this money if it's owned personally. If it's in a corporation, then it is vulnerable to lawsuits. And there's one more that I'm missing, loan options. Of course, there's no place in Canada or there's no asset available that they'll give you a loan under no questions. Right? Every time you want a loan from anywhere else, you have to ask for it and you have to qualify for it.
Oh, these direct loans you're talking about.
Yeah, right and you have first right to that money in the PAR account. Okay, so those are all the benefits. So let's quickly go into Universal Life. So Universal Life what came out in the 1980s, and it typically was there because GICs, you were making 14, 15, 16% on a guaranteed investment certificate. The whole life policies were, the dividend scale might have been at like 11 or 12. So people were like, well, why would I put money into this when I can earn at a guaranteed rate over here? Or I could put money in the stock market and I could earn 19, 20%, right? Interest rates were pretty crazy. So they came out with this Universal Life policy. And what it is it takes those three things. So we've got the death benefit, the premium, and then your cash value, or they call it the account value, and they kind of segregate them. And so what happens is, let's talk about the death benefit first. So you have a death benefit, and you can get a level death benefit, or you can get, it's called Face Plus, and it's different with different companies. So what the Face Plus is going to do, and I'll talk about that in a second, but typically, we're set up level, and you get a level coverage. The premium is similar. You're going to have two different options. You're going to have what's called YRT, which stands for yearly renewable term. You're literally renewing your term year after year after year. And what that looks like is it starts super low, looks really great at the start. Over time, that premium gets more and more and more and more and more, and then you get to a certain age. A lot of these can be set up to pay only up to like 85, and then they stop and they're fully paid up. But like, for instance, a 40-year-old is going to start at 1,000. The last year premium is 33,000. So the premiums
a year,
yes. So what I see a lot of times, they set up YRT because it looks great at the start and it ends up blowing up. Or we could set it up level, and that would just be that same premium over a certain period of time. Usually this is the same as a term to 100. So pretty much you're setting up this, you know what your cost of insurance is. So this is your cost of insurance, and it's either one of those two. So you're paying it level or you're paying it YRT. And the third part, and so this right now is a term policy. That's pretty much what it is. You're buying a term policy. But when you get into universal life, you can have this account value. It's a side account. Or deposit account, they call it. And so if you do a certain premium, you can, there's ways to put extra amount of money into the policy, and then you can invest it inside the policy. Now, of course, if you're investing it, you're taking all the risk. So, you know, who knows what those returns are going to be? We hope that they're going to go up. Now, a lot of times when you do illustrations, you have to project it at a certain rate. Well, in the 1980s, 1990s, they're projecting at 15%. Well, that's not true now. So if you project at 3 or 4% and you're very conservative, then it could look good. But why not just transfer your risk to the insurance company and use whole life? Really what these YRTs are set up, let's put more money in the account, in the side account at the beginning, and let's hope that there's enough money here to pay the later years of the YRT. To me, this is all about hope. And I don't love, insurance is all about transferring risk to somebody else. And so the way I see, and there is cases for universal life, and there is ways to get guaranteed rates in these side accounts, but they're fairly low, and there's not comparable to whole life. So universal life, the way I look at this, if universal life is like a defined contribution pension. So that's what a typical corporation's gonna have. You know, you put in money, we're gonna match it, and you're gonna go invest your money, and whatever you have left at retirement is what you can spend. Where a whole life policy is like a defined benefit pension. A defined benefit pension is like what teachers have, where you're putting money in, they're putting money in, and they're guaranteeing you income for the rest of your life. So much less risk, right? So that's why, you know, we're using the whole life primarily, because it's going to transfer that risk. We're going to let them do their thing, and they're going to get those dividends, and we're going to buy more insurance. We're going to use that cash value over time. But like I said, universal life, it can have its spot. It just doesn't quite make sense what we're trying to do here. Any questions on that?
Not on universal life, no.
Okay. Okay, so let's talk about why would we want any of these things, right? And now we find there's two main reasons someone wants term. There's 5 reasons why someone wants whole, and there's probably 2 main reasons why I would ever sell universal. So term insurance, what's the number 1 reason why people want life insurance in general?
Just income protection.
Yes. Income, and like typically because they love someone else, right? They have family, and they want, no one's getting, even if they have an income, they're not getting it on themselves if they're the only dependent. So family protection. And we can get that with all of these.
Because they all have death benefits.
Exactly.
Yeah.
If you set them up properly, you have to be careful, like I said, with the universal, because it could blow up, and then everything you wanted is not going to work out. So let's skip term for a second. Let's go into whole life. What other reasons can you think of why someone would want a whole life?
The loan thing, if you're talking about opportunities, then you can access the loan part, right?
Exactly. So one of the strategies we teach is like, how do you become your own banker? And we call it the private financing strategy. So how do you use this money to create money or give loans and make money like banks do?
Right.
So yeah, so what other things do you think, reasons why somebody would want whole life?
The cash value, obviously,
Yeah.
it's a safety piece.
Yeah, it's if we look at all of these benefits that it can create, then that's going to allow your $1 to do a whole bunch of things. So I call this the benefit multiplier. All right, what about the last two?
So like a tax advantage.
That's kind of in the benefit multiplier. Why would like a 70-year-old want whole life insurance?
Well, if you start it earlier, then would you not potentially have a higher ending?
You would, yeah. It's much beneficial. It's way more beneficial to start as early as you can, and you're going to actually get child policies for a month old. But if somebody didn't get it and they're in their 70s and they know that they're going to have money to give, then
So you couldn't necessarily access some of the other ones, could you, if you started later?
you could access pretty much all of these. It just depends on what you're looking for and what you're trying to accomplish. But really, it's like
estate transfer, like
exactly, yeah.
Okay.
So it's legacy or maximum legacy. Okay, so we can pass money to the next generation in the most efficient way. And the last one, we don't think about whole life about this too much, but we can actually maximize retirement income. Someone without a whole life.
Or
That's possible one way, but there's a few ways we'll talk about in the future of how do we actually maximize retirement income. Somebody that's retiring and they don't have a whole life policy, I'll never be able to give them as much retirement income because of the way that the whole life is structured and the way we can utilize it, which we're going to learn in the future. Okay, so let's talk about the last two things for universal life. So these are pretty unique cases, but I would say it's important to look at universal life if you're doing some corporate legacy planning. There's a lot of times where it would make more sense to use a universal life policy than a whole life, depending on a lot of different scenarios and situations. And then the last reason someone might want universal life is if they're older and they have some health issues. So it's going to be a rated case. So rated, just their standard. Rated just means that the insurance company is charging you extra because of a certain health condition. So those are the three main ways I see universal used. So let's go back to term insurance for a second. Other than family protection, why do you guys think somebody would want a term policy? And to give you a little hint, I sell some term insurance to 18-year-olds.
it's the cheapest.
Well, it's not the cheapest.
Is it?
The premium is the lowest, but it's actually
Sorry.
the highest cost.
Okay.
The premium's low, but why do they don't need any death benefit?
I'm wondering if they just don't understand how much money they're going to need later. They don't
Yeah.
understand how projection becomes really important, is my guess.
Yeah. Well, so it's actually because they understand the benefits of whole life, and term allows you to convert into whole life for no medicals.
Oh, so just getting started, basically.
Okay.
You're protecting your insurability. So we're only insurable until we're not. Anything can happen in life, and the insurance company can say, okay, now you're a risk, or I'm just not even going to insure you. And if you don't have term insurance, then you can't get into the whole life. And if you can't get into whole life, then you can't get all the benefits it's going to create and the efficiencies it's going to create in your model. So once you understand that, then typically you might want some term, especially anyone over 18. Okay, any questions on the whys? Make sense? Great.
Thanks a lot for watching that video. Check out some of our other videos. Subscribe to our channel. Feel free to reach out anytime. We're looking to work with great people long term.